Good, thank you. Thank you for being here. It's crazy to be at this Odoo experience. Is this my third or fourth one I joined this Odoo experience because I've been, had the pleasure to follow this company for many, many years, and this is such a great community. It's incredible. But I'm also conscious that we are the last one before the bar. So we are between you and the bar and the party tonight. So bear with us. So my name is Tanguy Piret. I'm a global chair of JP Morgan. I've been, let's stop counting, above 20 years doing this job. Raising money, IPO, equity private placement, M&A, whatever you name it, we're doing this. And I'm joined with my partner, Matt. Matt, you want to introduce yourself?
Yep, hi everyone, Matt Gale. I head up the tech investment banking group at JP Morgan, helping companies to do M&A, raise money solely in the tech sector on a global basis.
So you can see Matt speaks a little bit better English than me, but so that's normal. So we're going to try to cover a very broad topic. So you had your coaching before. Some of you went to the previous session to do how to pitch investors, how to coach, how to do the 2 minutes pitch and so on. The problem afterwards is that you need to talk to investors, and this is where we come into the pictures. When you've done your rehearsal and your coaching, you need to go straight into the field, jump from the plane. So we're going to try to cover a couple of topics today. Unfortunately, we are bankers, so the first thing you start when you talk about raising money is what's the environment? Where are you raising money? What is the investment now? What is the economy? And so on. This is the first basis. So I'm going to try to cover that a little bit. We're going to give you example as well as try to cover as well what are the trends. Because there's no point to do raising money where the trend is against you. When you swim against the tide, you will never make it. Just forget it. Follow the tide. You need to be through the tide. So we try to cover that. We're going to try to cover as well, what we see are very simple basic rules, basic lessons, to-dos and not to-dos. We're not going to be as a coaching. This is not our job. But we're going to tell you when we talk to investors, what are the trends they see, what they want to do. So that's a bit of the element we're going to cover. And also try to tell you as well, what are a little bit the tricks, which these guys apply or not, and try to cover that in 30 minutes. We're going to be relatively short because we want to cover Q&A. I'm sure you have plenty of questions. I don't know if you're raising money for the moment or not, or you intend to raise money. So that's going to be something, we're more than happy. No taboo questions, please shoot. We have no problems. We have tough skins, we're crocodiles, so just don't hesitate to shoot and interrupt. That's the idea. So if we start about the 3 topics I will cover today, the state of the capital markets and focusing on raising money, which is what I'm sure you cares. I'll talk a little bit about Belgium, even if this Odoo experience is a global experience, so I'll really be short because some people are not Belgian, they don't care about the country. And then we say what are the successful trade of business which investors want today. So when we start to raising equity, the first thing you need to look is what's the state of the markets. Don't raise money when everything falls. So when you look at the trends and the recent evolution, if you take 23, 24, you can see that everything is going up. So you say 23 was a recovery, 24 was, to the surprise of many people, including ourselves, a positive year for the equity capital market. So I'm sure if you invested money beginning of the year, you're all smiley, you made money. But the question of the market for now is, are we at the end of a cycle? Are we going to turn? Are we going to stay with a positive cycle as we have now or not? I think the element which we track, which you guys may not look, is the last number, VIX. What is the VIX? Is the volatility of the market, is how quickly the market turns. And the problem with investors, when we see, this is the 2 elements which is very important for us, is one, is when we raise equity, and investors, when there's huge volatility, guess what? It's not going to invest. And second as well, when we do IPOs, initial offering of companies on the stock exchange, when the VIX is high, we all go for skiing. We don't do business. So that's I think an element. And you can see we had a big spike in August. There was a bit of a panic mode, and now it's back to the average. And that's what you see. If you read the press this week, there were 4 or 5 IPOs, and so people are rushing into the market to raise their money. So windows are important. When to hit the market is super important for you, be it private or public. I think that's super important. The second element, of course, which is important, is the economy. So what you see in the market is inflation is coming down slowly, rates are coming down, and are going to continue to come down. GDP is somewhat average, and the stock market is okay. What does it tell you? It tells you that it's an okay market. The problem we have now is the visibility. Who could tell end of the year, in a quarter from now, it's going to be positive? So that's why you have not so much activity on the market on the IPO, because investors say, if I put my money to work now, Am I sure in 6 months down the road, when really I'm going to have the next talk to the CEO who I bought the business, it's going to be there. So the visibility is poor, driven by geopolitics. Everybody knows about all the wars, elections everywhere. So there's a lot of problem in the economy where people say, I know by the end of the year I'm going to be okay, but am I going to be okay for the next 12 to 18 months? Which raises a little bit of a concern from investors. If we move now to the tech activity.
Great. So thanks, Tanguy. So shift from the broader markets to where we are for tech. So before telling you what's the situation to raise money, we have to look at how you can get the money back for your investors. They're not giving you money just because you got a great company. They're doing it so they earn a return. They can get their money back one of two ways. They can either sell the company or they could IPO the company and eventually sell in the capital markets. This looks at what's been happening in technology M&A. So the left-hand side of the chart is the last 5 years for tech M&A. We're at the right-hand side of the chart, which doesn't look very good if you looked at what was happening in 2020, 2021, and 2022. But year to date, we've almost eclipsed where we were last year. So things are better than they were last year. They're nowhere near as good as they were in 2020, 2021, and 2022. But there's positive signs. There's uncertainty out there, but there's positive signs, and we'll talk through this. Why is this so important? Is because investors need to get that money back before they deploy that next dollar. And I'm not just talking about the VCs of the world. The VCs' money is coming from the big limited partners, the pension funds, the governments. Those governments want to see a return before they want to see those people putting more money to work. And so until we start to recycle the capital, we're still going to have a tough environment for funding. The right-hand side just talks about some of the themes that are driving M&A, what can interest somebody in buying your company over time. We're seeing focus on growth. The SaaS transition is becoming a little bit in the past. Now it's all about how to build an AI story. And so strategics are coming to us, and the first question they ask when they want to buy a company is, what is this company's exposure to AI? Is it a positive, is it a negative? What can they do for my company? That's probably the biggest prevailing thing that's driving interest from strategics. Sponsors, and we'll talk about this in a bit, financial sponsors are a critical element for selling your company these days. You can see on the bottom of the left-hand chart, around 40% of all tech M&A is not selling to SAP or Oracle or Microsoft or Meta. It's selling to a CVC or an EQT or a Vista or a Thoma Bravo. And so setting your company up to be able to be potentially bought by one of the financial sponsors is a theme that's only getting more and more and more important. And having a story that works for both a strategic buyer and a financial buyer is therefore very important when you go out and raise capital. If we move on to the debt markets, I know a lot of high growth companies aren't necessarily that focused on raising debt. But this is really important, again, as we talk about financial buyers. Financial buyers are using oftentimes debt and equity to buy your company. When debt is expensive, it's harder to get a lot of debt. It costs more to get debt. When debt becomes less expensive, you can put more debt on a business. What we're seeing right now is the debt costs are coming down and the amount of leverage you can put on a business is going up. This also impacts the big strategic buyers. The cost of debt comes down from the highs that we've seen over the past 2 to 3 years. It becomes cheaper to finance M&A. So this is really a positive signal, and as we start to see the rates come down, we should start to see that accelerate the M&A environment. One of the big questions everyone asks us bankers is, what matters more, profitability or growth? Back in 2020, it wasn't even a question. It was growth, growth, growth. This is a fairly complicated chart, but what we just tried to do here is run a regression of what is more important, growth or profitability. The big blue line on there you can see is, what is 1% of growth worth compared to margin? And this will tell you back in the crazy days of 2020, 1 percentage point of growth was worth 9 percentage points of margin. So it was worth it to go from a 20% margin to an 11% margin to go from 10% growth to 11%. It's pretty crazy, but that's how much people valued growth. Investors still value growth today, but nowhere to the same degree. You can see the ratio is now about 1.5 to 1. Growth is 1.5 times more valuable than margin. So this is much more normal. If you look over the last 25 years, it's always been between 1.5 and 2 times. So I consider the market has returned to normal rather than we're all going to go back to what we were in 2020 and 2021. This is a very busy chart, so I'm going to give you the 3 takeaways from this chart first. First is, what does growth look like for a public company has changed an immense amount over the last several years. And I know most people in this audience are not planning on being public, but again, everything trickles down. Investors can invest in a public company, they eventually can invest in a private company. The profitability profile has changed a bit. So where do you need to look? If you look down at the bottom of the chart here, the software universe average. This is every publicly listed software company across Europe and the US. In the peak, the average growth rate was 16%. Currently, it's 11%. In the peak, the average EBITDA multiple was 16%. It's now 25%. So you can see in the public domain, a big shift has happened. And so when investors are looking to invest, again, if I'm a pension fund and I'm putting my money into the public domain, and I'm seeing these companies with lower growth and higher profitability, and then a VC comes along and says, listen, I want to make this next investment, they're asking the question much more of, where's the growth profile look like? Where's the profitability profile? The second thing that I want to take your attention to here is growth in the public markets is not what it used to be. We've sub-segmented here growth, ultra high growth 40%, high growth 30 to 40%. I'd like to show of hands here. Who thinks there are more than 10 companies that are growing north of 30% in the public markets? Anyone think there's more than 10?
Globally.
Out of 157, no one thinks there's more than 10? I'm kind of setting up the audience for the question. Anyone think there's more than 5? Anyone want to guess how many companies are growing north of 30% in the entire publicly listed software universe globally? 3? You're too high. I like this. He's very optimistic. If you're an investor, go talk to him afterwards. 1. One company, one software company globally is growing more than 30% in the next 12 months. It's an astounding statistic. And it shows, again, the framework these investors are looking at is very different in the public sphere than it used to be historically. And so when you tell your story about where your company is going to be in 4, 5, 6 years when you go public, it doesn't need to be growing 70 or 80%. You need to have scale, but 30%, you're in a class of 1. That has really, really changed the game. The second thing is the value for growth, the dispersion for growth is not what it was. And so you look on the far right over here, you can see if you were growing 40% or more in the last cycle, you got valued at 46 times. Currently you're being valued at, what does that say?
8 times.
8 times. That's not that different if I'm growing 20%. So the differential in valuation I get for that growth, for all that pain and suffering to get to high growth is not what it was. And that does cascade as we start to talk about the private markets more and more. Final thing I'll give you, because we get asked all the time to raise private money for companies, and everyone comes out and says, you know what, I'm much more rational than I was before. I'm going to take a 20 times multiple. You know, I 50 times last time, 50 times ARR, I'm going to be very smart. It's just 20. I'm not going to ask the audience again because I saw the response last time, but I will tell you, there's only 10 companies globally that trade for north of 12 times sales in all of software. 10. So when you're going out and telling people, I'm going to be very, very value conscious, I'm going to ask for 20 times, keep in mind, there's only 12 companies in the globe that are publicly listed that trade over 12. So it's been a framework reset, and this is cascading into the private markets when people are going out to raise money. And until we start to see these valuations go up again, and we start to see the IPOs go up again, it is going to have a bit of a chilling impact on raising money privately.
So if we look at the private market and you see the graph as well at the evolution, you can see really the peak of 2021, and it was aligned. The blue line, I think it's the private market. So when we raise private money for VCs, private equity, and whoever investors, and on the orange line is the public market, and you can see the trend is going down. And you see that 2024, you can see it's stabilizing because it's year to date, so you can see that it's going to be better. But I think what is important for you is the right side of the page, which is right for you, yeah, right side of the page. Is, as Matt mentioned, you know, before in 21, all conversation was on growth. 100% of our conversation, I remember I was seeing business plan, there was not even a cash flow in the model. The guys were just for growth, and there was revenues, and that's it. And we were asking questions, and the guys say, "Why do you ask?" This has completely changed. So if you try to raise money for the moment, you need to be balanced. You need to be balanced, and the path to profitability is important. Why is that? Investors I've seen understand the cycles now, and they say sometimes you can raise, sometimes you cannot raise. And if you end up being no cash during this no raise period, you close your business. It's easy. And that's why we see a lot of business, in biotech industry and so on. Every week now in the newspaper you say file for bankruptcy or looking for desperate investors or debt holders that put in to freeze the debt to be able to raise new money. There was again, I think, 5 articles today. I think that's important. I think funding aggressive production was the past. Today it's not the case. Don't come with completely skyrocket. As Matt mentioned, you don't need to be at 80% growth. That's not what the guys are anyway going to massively discount that. Clean raise. Before, the only raise we were doing was equity. So private money, in simple, I join your register, I become a shareholder. No longer the case. Many of the raises, and I'll come back to you later, are done through very different instruments than today. Preferred equity, convertible bonds, structured financing. That is a way as well to bridge the gap between a founder who wants to raise at 20 times and an investors who tell you, look, I'm at 8. Never gonna work. Forget, let's stop talking. So that's the reason why you have this instrument to bridge the gap, to go back to reality. It's painful, but sometimes when you need the money, you need to take what is available. And for the moment, most of the equity private placement we saw, most of the raise, a lot of the raise are done through these instruments and not straight equity. Chasing fast-moving bidders. So 2021, people were rushing to get to you. They were saying, I want to invest, let's do a quick deal. No longer the case. Huge due diligence. Take the time, get prepared, get your data cube. If you're in tech, the data cube, and be prepared for long discussion with your investors. Don't believe it's going to be a quick deal. I'm done in 2 weeks. Thank you very much, and I raise the money. That's not what happened for the moment. And I think before, in 21, whatever, 70% of our deals were tech, no longer the case. Investors are also pivoting. And I think that's important as well, depending on the sector. Make sure you raise money when the flavor of the day. Today you like chocolate, tomorrow you will like apple. Don't go and sell apple when the guy was chocolate. Sorry to say, the guy will have zero attention. He will take your pitch, throw it. If you have a meeting, you'll be lucky. The guy will say, I have no intention. Second is, and I'll talk to that later afterwards, is investors have a bucket. When their bucket is filled, even if you have the smartest idea on earth, they will not invest. If their policy says, I'm a VC fund, I want 20% in software, I want 20% in biotech, if they are 20%, don't spend your time. The guys will never invest in you because he will not be allowed. He will go to the top, you're gonna have a nice controller, he's gonna say, no, you're full, move on, wait the next fund. And I think that's quite important to keep in mind. So being in the right moment, in the right place, and sending the right stuff to the right people. And I've seen so many times clients like you guys trying to raise money, and they were talking to an investor for 6 months. And why it's happening? Because you have a junior guy, he wants to keep a living, he wants to understand, but he has no capacity to invest, and you waste, you spill, and the guy says, it's a great story, I love it, it's great, yeah, let's meet in another 3 months. Why does he say that? Because today he cannot invest, but he wants to stay in the flow, so that when there is a next fund, he can be there, but he makes you waste your time. So be mindful about that. Be sure that the guy can invest. Sorry, let's...
Yeah, and so just want to give 2 examples. This is selling chocolate when people like chocolate. So two examples I think are useful. We raised money for Scale AI earlier this year. What's interesting here is if you are at the right moment at the right time with the right investors, things can go incredibly well. And takeaway here, this was a 250 million raise that turned into $1 billion. That's what the demand was. The second thing is on the bottom right, look at how many names invested in this company. These weren't names that we called the week before. These were all names that were being cultivated over an extended period of time. AI was not, shockingly enough, the flavor of the day 2 years ago. It was interesting, but we didn't have all these names ready to invest. And so they brought them along. And then when the opportunity was there, we were able to have a lot of power on the terms, get the deal done in very quick order with our US team. But it's not always about tech. I think this is an example with Envira, which is in the distributed energy space, essentially end-to-end solar company in Germany, a very hot space overall with distributed energy. Here's a business, when the tech markets are cooled, we see BlackRock, the biggest investor on a global basis, turning toward energy transition. So this is a story we would have told a big tech element to if we were raising money, by the way, 24 months ago. Instead, we embraced what it was. We embraced energy. And that's what drove this deal. The other really interesting thing here is this deal wasn't all about primary. One of the things that's changed with investors is you don't have to only raise primary money as you become a bit larger. you can actually go out and actively raise secondary. So we saw a lot of the early stage investors here took money off the table well in advance of an IPO or a sale. And so that's something that no longer scares investors, provided there is some new primary capital going in with the raise. So beyond the private markets, wanted to talk a little bit about IPOs. And again, I imagine most of you in the room aren't thinking about an IPO today, but IPOs that I mentioned up front are really important because once those start happening, the limited partners, the pension funds start letting the VCs invest again. They start doing the pre-IPO raise. Fidelity shows up and wants to invest in private companies. Tiger is back, throwing money at anyone that walks and talks. So where are we right now? We think there's 3 waves in the new IPO cycle. We currently are in wave number 2. Wave 1 was last year. We saw essentially 3 tech IPOs. We all got quite excited when ARM went public, and then nothing happened. Wave 2 started in March of this year. We've seen 8 IPOs come to market, and we're getting increasingly optimistic as we look into next year, where we think we could be starting a super cycle of IPOs because there have been so many companies that have stayed public much longer than expected. They've gotten much more substantial, in many cases to the level where there isn't a natural buyer. So we think you're going to start to see a really active IPO market. And probably the most important stat on here, and we'll go into a little bit further in a second, is that in the 2024 IPOs, the vast majority have made investors money. And the thing I learned in banker school is when investors make money, they do the same thing over again. So when they're losing money on IPOs, they don't want to buy any more IPOs. If they make money on IPOs, they will buy more IPOs. So they're making money on IPOs. What does that mean? More IPOs. So that should be a very positive thing, and it will trickle down through the entire market environment for everyone in funding if we can get the IPO chain spinning again. Last thing I'll talk about on IPOs is they have changed. If you're going to tell a story to your new investors, hey, I'm going to IPO next year, I'm going to get to 100 million of revenue, I'm going to list at $1 billion market cap, and I'm going to sell 100 million of stock. You've lost the investor right away. If you look at this chart, other than the huge bars that we aren't seeing anymore, the things that are interesting, I think, are if you look at median IPO size, the second row down, 246, 432, 400. Look to the right, $740 million being raised in the average tech IPO right now. These are big, big raises. What's the percentage float? 15%. Some of you can do math quicker than I can, but that equates to about a 6 or 7 billion market cap average. The companies going public are very, very large. Now, we will eventually, as the market gets going, start to see smaller companies going public, but it's going to take quite some time, and maybe not again are we going to see the $100 million single product SaaS company going public. So again, this is really important when you're telling your story on the path to exit. You got to tell a story that fits with what the market wants. Otherwise, that investor is going to shut off their mind and not really take seriously your incredible company.
So as I discussed a little bit, I think it's important, it's on the private side. So if I look at the wave 21, we were always on the A column. So it was very easy. We were just raising equity. There was no problem. In the worst of the market, you go to the right, which is fundamentally you raise the debt, you don't fix the price. The price is fixed at the end. And when you IPO, where you exit. And the middle column is where we are working for now, for the moment, with most of our equity private placements. So we are really between A and B. B being, it looks like equity, it's not really equity, but it is an hybrid. So it tastes like, it feels like, but it's not really like. And I think that's where we have, and so these are coming very structured instruments, which on one side can give either protection to the investor, so a floor value, a floor exit, or a minimum return, so that he can go to the IC, I'm not betting the house. So I'm not gonna, I may lose money, but I may not lose completely my money. And I'm going to be repaid before the founder. That's basically the philosophy with the IC guys, especially on some more complex story, where either there is a big alpha in the story or a big alpha in the business plan, where you like the business, you may not, the IC may say, I don't believe you in the business plan, so you have a tension between the partner who pushed the file and the IC, so the investment committee at the top who basically say yes or no. And that's why we are more and more working around these structures, which are indefinite. The creativity is unlimited. Every day we see another structure. But I think you need to be cognizant that don't say no immediately to this type of stuff. Of course, everybody wants to go to the A column. That's the simple, it's the cleanest. But don't be too firm to shut down people, because even if you are on the B column, you can move over time the people to say, oh, hey, you like it now, we've done, and they turn to the A column to real equity. So I think that's what important to keep in mind. Maybe you want to switch.
Yep.
So one thing about, which is going to shock you maybe, we are supposed to be a very rich country with a lot of savings, with a lot of people, but the appetite to risk and the amount of unicorn, business above $1 billion or even multi-billion, there are very few. One here today, Odoo, but very few. And you look at the rest of Europe, it's appalling to see where we rank. So, and I heard a lot of message about daring and trying to be bold, but the reality is we don't have high daring people who go big, who go really all in into this. And I look at the next page, which is the amount of invested capital in the country, in the VC, in private tech company. We rank very, very, very low. While we have the biggest saving in the country there. So the mentality of people locally to invest in high risk, high return, but high risk people in this country still, they always want, and I've seen it, I myself Belgium, so I can talk about it, people always want to win. But if you invest in VC, you know you're going to lose maybe 8 times out of 10, and you're going to win big time 2 out of 10. But the mentality is, that's why when you raise money and you have a high profile, high growth or tech business, don't be, try to raise the money where people are used to win and lose. Because the flexibility of people to go into, I go all in equity. So I think that's an important feature as well. When we work with clients in this country or in Benelux or in France, it's a bit more advanced. It's always, we need to go global. You need to find the money where people are used to what they like and are used to do into this type of businesses, which are high volatility business, high beta business plan, so you don't convince. So what are the three business of successful business and how to raise? And I try to frame it in very few, in 9 boxes, and the first one I always say to client is, be prepared, but seriously prepared. So many times we see when we work with young companies or startup companies, is that they say, oh yeah, we know our business, we're very prepared and so on. And when we dig and we ask questions or we go into the business plan preparation, it's light. And why is it light? Because the guy, of course you're super busy trying to deliver your business on one side, you work already 200%, but if you don't take your job at 200%, the investors are going to realize very quickly that it's very tough. The second is, as I told you before, find your equity story to what people want. And don't go into the market when people don't want to listen, because then you're going to really, really waste your time and you're going to pollute your story and pollute your name. Because the worst which can happen for an entrepreneur is to fail. Because then first, everybody is connected in the industry. Everybody know about the fail raise. So don't believe people don't know. Everybody know when you struggle and fail. And then you see another type of investors. I don't want to describe these guys. They come in long black coat and they're going to rip you apart and they're going to take your business away from you. The third element which we say is raise when you can and not when you need. So the problem we see with a lot of investors, it's sometimes they wait a lot. And they call us when it's either late or about to be too late. And we ask them the question, how much cash burn do you have? How much months do you have? And the guys say, look, I have a quarter before I'm empty, or I have half a year. And the problem you see, cycles goes not within your cycle. So you have your cycle, and then you have the market cycle. And guys, if you bet to be the two together, good luck. I've done this business 27 years. I've seen the overlap of cycles. You need to be lucky. Play lotto, you have better chance to raise the money. Frankly, when there is money on the table, and you overfund, and there are a couple of examples, I think the gentleman is on the biotech. I remember Argenix. As soon as the market was open, they were raising money. And they had 2 billion on their bank account. And the guy say, I want 3. Because I don't know if the market is going to shut down. I don't care. I take the money, I can success, and I can forecast my next 3 years. Doesn't matter. And yes, it is painful to be diluted. But guys, I can tell you, some investors, when they shut, and they shut for a long period of time, there is a tracker, which we have as well, and it's really not nice, but this is what investors have. They have a mega database of all the companies, how much cash you have, how much burn you have per month, and they're going to start calling you. My friend, how are you doing? You doing well? Yeah. You want to? No, you don't want to? Yeah. No, it's okay. call you back in 3 weeks, 1 month. And then they exactly know that is when the pain point is, and that's the moment these guys are gonna hurt. So try to reverse the engine, because if you don't need to raise, the market is there, suddenly the guys are gonna crush into you and try to bring your money. Yes, you'll be a bit diluted, but you're not gonna sell your business for cheap. I think speak to the right investors, please, please, please. On and on the same mistakes. I've seen so many guys who say, I have a fantastic relationship with investor X or investor Y, and then we call the boss of the investors and say, hey, we have Patrick, he's talking to this company for 6 months now, is he good? And you have the boss say, what are you talking about? Never been to the IC with this ID. And then you know, you've been wasting 6 months. So please, please check, can they invest? Where they are they in investment cycle, raising cycle? Where is the fund? The maturity of the fund? All of these indicators are super important. It takes a lot of time, but it's really important because so much time you can waste. Create competitive tension. Don't be hostage to an investors, please. Even it takes time, it's pain, it's a lot of calls. Please raise the tension. As soon as an investor knows that it's quasi-alone or preferred or exclusive, guess what's going to happen to you? Don't need to describe. Adjust value expectation. I think Matt described it. You know, if the market is at 8 times, no way you're going to raise at 20. Even if you have the smartest idea on earth, no way, because the guy at the IC will have to say, where's my peer group? Oh, the peer group is at 8 times, so why do you want me to pay 20? And the guy get destroyed. Because the IC will say, there is no reason why I'm going to go to the next opportunity. I don't want to be the stupid guy who looking from my boss and I've invested 20 times and betted the house and lose my job. Because this is what these guys happen when they made a mistake. I think, as I mentioned, the last one, equity, the credit story, equity versus preferred, please be mindful. The last point, which is difficult for you guys when you raise this, build your board. So many times I've seen companies where the board is, guess what? Their neighbor, their friend, their father, their uncle, student from school. No, please take the effort to have a professional board who bring real value to you. And I know when you're a small company, it's difficult to attract talent, but there are many guys who are happy to help, who have done this exercise in the past, who knows the sectors and bring value, bring you an international touch and so on, rather than having your friend. Yeah, your friend is very useful. Get a beer with your friend, but don't bring him on your board. Because investors will also say, what is this board? They're going to ask this question. They're going to say, it's very odd. And I think the other element is, which is linked to my third point, is maintain the dialogue. I know for you it's painful, but as soon as you have investors or new investors, don't say no, even if you don't raise money. Welcome the guy, take a coffee, say, I don't have time, but I'll call you back. Because this network of guys, they're doing work in the background. They're not going to listen to your pitch, but they're going to do work. They're going to listen. When they meet other investors, they're going to say, oh, have you heard about this company? It looks great. They're going to understand, oh, it's a great company. They're going to come back. If you don't have all this network and you don't know all the people and it's the first time you do your pitch, listen to the previous speaker. Say, you have 2 minutes pitch. If you miss the 2 minutes, you're gone. Yeah, guess what? If they heard 20 times the story before by other people and they know your story, you don't need to do your pitch. They're going to say, wow, it's a great company. We know 10 investors talked about you. I really want to see you. That's a completely different approach which you need to keep in mind. And then for us, of course, we're bankers. We like data. We like figures. We like business plan. And then we like data cube, which is what our guys in tech are looking. I think it's important to really have proof point, reliable. Don't get a business plan which is very complex, too complex, which you cannot test. The investors are going to try and test your business plan. They're going to look at the key drivers, make drivers which you can monitor and track. Don't invent them for the pitch, because afterward they're going to ask you the same question 6 months down the road. You won't be able to match it when they see you again. So I think there's a lot of element about that. Don't put constraint on your business by building this business plan to fit the investors, because then you can't function. I've seen companies who created something super complicated, but they could not operate because the investors wanted this, but it was not the fit of the business. The investors need to adapt, but you need to have clear data cube which you can really track, which afterward they're going to send to some analysts to analyze, and they want to make sure that when they put it in the number in, the same number goes out. And when they ask you a question once, they get the same answer twice. And sometimes with complex model, you get 10 answers different from the different model, different data, and it's over complexified. While these guys are going to be Very analytical, but simple. If they don't understand your business plan after a few minutes, you lose them, it's over. No point to spend too much time with these guys. I think, and I think the last point which we see sometimes, it's my last point. Be careful about competitive, sensitive information. If an investor has looked at a sector, he has spent hours, hundreds of hours to understand whatever, software for restaurants. Guess what? He's going to reuse the information for another business which might be your competitor because he has done the work, he has a huge capex, he spent money, he spent time, he wants to pick the right target in the industry. So if you have too much sensitive information and he invests in another company, your business is toasted. So I think that's an important question. I don't know if you have some point, Matt, on the business plan and KPIs because you do that as a living as well.
No, I think it's well said. So I think that was probably our last.
Yeah.
Yes. Okay. So I think with that we were happy to take any questions.
Okay, so if you have any questions, guys, feel free to go to the Pad link and then put your questions there and we'll ask to the speakers.
If you have a question, you want to shout it out, I can repeat it as well.
You can take the mic if it's easier.
Yeah, if you want to ask directly, you can come closer a little bit here and you can use the mic directly or just use the pad.
Okay.
Yeah, go ahead.
You have to come a little bit closer here.
I don't know if it's a real good question for you guys, but because you talked about the third wave coming in 2025 concerning IPOs, how do you feel as JP Morgan itself as the underwriter of those IPOs concerning the volatility? Because if you put the stocks for a certain price on the market, but there's a lot of volatility or it goes very well, like with a lot of optimism, you lose out a lot of money for the investors because it's going to go to the secondary market after all. So yeah. I had a question concerning that.
It's a really good question. It's this constant debate you have with people because people say, well, I did all this work my entire career for 10 years and I take this company public and it goes up 30% and I literally just handed that money to other investors. It's a constant balancing act. But I think that's why you typically in an IPO are seeing people sell 10 or 15% of the company rather than selling 50 or 100%. You have to sacrifice that because if you think about this at the end of the day, while Tanguy talked about how to bring the private investors along, it's a multi-year journey. The public markets, you're meeting for the first time oftentimes 6 months before IPO. They haven't spent years. They can't do the same level of diligence. They don't hire BCG to go into your data. They're looking at a legal prospectus and anyone's ever read something a lawyer read, I mean, good luck finding real information in it, right? So you have to compensate them for the risk. And so you're going to have to give something away to them. And when that volatility level is higher, there's more risk for them. So as a result, you're going to have to take the risk that to get public, you're going to take a bigger discount. And that's one of the reasons in the last cycle, it's been super volatile, investors have been super cautious. You could have done IPOs. The investors in the public markets want this huge discount versus the public comps. And people are saying, why should I do that? So private equity came sauntering along and said, you know what, I won't have to pay that big of a discount. I'll take a 20% discount. By the way, I'll buy your whole company. And so we've seen much more activity there or strategics rather than IPOs. That volatility's come down, investors have made money, slowly but surely, instead of needing a 30% discount, it's going to become a 20% discount, a 15%, a 10, and that will get the IPO markets going again as that bid-ask spread becomes a little bit less.
Because we've seen in like the last years that IPOs have become far less attractive than just staying private. So I think it's going to be very interesting towards the future. How that's going to evolve?
For me, we talk about IPO or private market. It's just a mean to an end.
Yeah.
If you are an entrepreneur, what do you want? You want to be a successful business, having the funding and the cash. And then you need to assess where can I get the best buck for my return.
Mm-hmm.
So, and sometimes it's a private market, sometimes it's debt, sometimes it's equity, sometimes... And I think you should be open-minded about that, depending on where is the money, at what moment, where is available. And you may say, look, today the equity public market is open and the private market is shut down. And then you go to the private market and vice versa. I think for me, that's the way to be, agnostic and not emotional about it and oh, it's prestigious, I do an IPO. For me, if it was my business, I say, I just want the money at the best return and not being diluted and get less problem and run my business as quickly as I can and don't waste 2 years waiting for Godot that all the stars are aligned.
Okay. Perfect, thank you.
Thank you.
All right, we finally have some questions online. So first one, with interest rates falling, do you see growth becoming more important again?
Yeah, I think so. I mean, there's just it's straight math, which is when interest rates are lower, there's more value in future growth than there is in today's profitability. So yes, you're seeing that. Now everyone learns that in business school, and then actually directly applying it to the markets isn't the simplest thing, but you are definitely seeing that, and all you needed to see is once the market catches wind that there's going to be a Fed rate cut, you start to see all the high beta stocks, all the forward-focused stocks start to rip. They don't actually go up when the interest rate gets cut. They get cut when people think the rate's going to get cut. So yes, we definitely see that, and I think that's going to be a really big component, again, of the IPO market coming back. If I can invest my cash and make 5%, maybe as a retail investor, I'm not putting money to work. If all of a sudden my cash account's paying 1%, I might decide to open a Fidelity account and invest. And so that's also a really big thing, because one of the things people forget about is when you buy an IPO, where does the fund manager get the money from? If they don't have Tanguy or I or someone out there putting new money into their fund, they have to sell something they like. Okay, it's a zero-sum game. But as soon as we have a bunch of more funds coming into the mutual funds, they're looking for where to put the money. And that's when IPOs really work. And so actually that's another big element of why lower interest rates are actually good for IPOs.
The only point, I agree with Matt, the only point I'll put as a question mark is, why are you lowering interest rates?
True.
And one of the big signals, which is one of our concerns when you see cloud, is because the economy is massively slowing down.
Yeah.
So that could be the counter force. You could see that it's the Fed or the central bank are doing that because they see that the consumer is not spending, China is a bit worse, the US leverage is going up, so that they are forced to do the cut on interest rate to make sure that people go to shopping, buy the new watches, the new pair of shoes, the new car, to do that. And if the driver is only that, then you're going to see the conjunction that the interest goes down, but the economy goes down, then people will not want to invest. And what they're going to do, they're going to go into high dividend yield, low growth business, which are more secure. They're going to go back into real estate, where you have a coupon which is higher than the interest rate. So you could have these different forces which act, but yes, the rule of thumb is that when interest rate goes down, equity, there's a wave of equity and then investors put money more toward to the stock market.
Mm-hmm.
All right. So next one. So you guys mentioned not to talk about too much confidential information earlier. However, it can also be confusing as you have to pitch something that makes you unique to have investors. And it could involve confidential information. So how do we go about this with various investors?
Mm-hmm.
Is giving breadcrumbs a good idea?
Yeah, I think the way we look at it is it's a staged approach. You see, if you show up and your pitch deck has no numbers in it, good luck. I mean, people aren't going to dig in. You need to give them something to work on. The next time if they're showing interest, they're leaning in, you can give them a little bit more information. If they're starting to talk about valuation numbers and, hey, to get to this level, I need to do this, okay. I'd always ask, as Tanguy mentioned, have you been to your IC yet? I don't want you to see my data cube until I at least understand who's the senior partner that's representing you. So it doesn't have to be one way where they ask you information. you can ask them information. If it's clear the investor's doing work, clear the investor has the buy-in, you start to give more and more, because you're never getting a deal done without sharing a lot of confidential information. You just don't need to hand your entire data cube to anyone that calls you. And too often we see that. You're like, what's been out there? Well, I sent a 10-year financial model out to 60 investors last year. It's like, well, can I see that model? Yeah, we missed that model by 50%. It's like, oh, Jesus. Like, so the starting point is no one believes any of your numbers. We didn't need to share it with 60, but we all miss our numbers. But share it with 5 people. You know, don't share it with 60.
Okay, so the next one, what factors should be taken into account when deciding between private funding or taking a loan?
Taking up?
A loan.
Well, I think it's quite simple that depending on the stage of your company, you know, if you take a debt, it's a debt, so you're forced to repay. So there's going to be no negotiation, and you're going to give the key if you don't repay the debt. So, you know, depending if you don't have profitability, don't have any cash on balance sheet or ability to repay the debt within the time horizon of the debt, when you're short, don't take it. Or at least negotiate the term properly and focus on equity, because a lot of the investors we see sometime on businesses take too much leverage. Usually it's later stage type of companies, but you know, if you cannot go through a cycle and you're burning cash, just take equity. Because if you go through a cycle and you are 5 times levered already, and there is a cycle and you hit your covenant, guess what's going to happen? You're going to end up into the back office of some banks who have no idea of your body of business. The only thing they care about is getting their money back. They will have no appetite to understand what is your business, what they want to do, because the guys in this back office, they have no time to understand business. They don't care. They will only focus on, get me my money back. So I really advise you, don't go there, please. That's going to be very, very dangerous.
All right, yeah. So I think we have one more
Okay,
question
sure.
before we end. So did the volatility in August cause a lot of panic in your office?
Not really. To be frank, look, we run so many scenarios. Look, first, we are a very large organization, so I don't know how much we have, hundreds of thousands of employees and billions of capital. It's all about management of risk, knowing your risk and knowing your exposure. And we run zillions of scenarios, and this scenario is not something where we are concerned, to be clear. So you could have triple the spike or triple the drop. This is not where we are concerned. If you talk to Jamie Dimon, the first thing he's going to say is what are the real risks where he doesn't sleep at night is geopolitics, and geopolitics. That's it. The rest he can handle.
Yeah.
So that's really the concern he has. So thank you. I don't know if there's any more questions, but thank you.
Can I just I want to add one thing to that thing, because I think you said raise money when you can, not when you have to. I think a lot of people come up with these careful timetables of when they're going to go, and hey, we're going to hit this window. And you know, let's say you were trying to raise private capital and you said, I'm going to have my close date is going to be August 15th. And I'm going to be out of capital on September 15th. This is an example why you can't rely on that, because nobody would have expected the sell-off we saw in August, because it didn't just hit the public markets, right? It killed every process we were working on across the entire tech sphere. So if you're out there in the middle raising capital and you don't have a runway to extend, that's when you got a problem. And so that's why you can't ever leave it late. Because these volatility bouts, by the way, with crazy people potentially running half the governments in the world, you don't know what's going to happen. Geopolitics is scary, but just talk about politics. So we just tell people, be ready early, and when the window is there, go and go fast. Don't get exposed to the market for a long period of time. So that would be the last lesson to give you. But guys, really appreciate you taking the time. There's nothing more powering than seeing this many exciting companies and all these investors around Odoo. Hope we all can take you guys public, or your companies public, depending if you're an investor or company, sometime in the next 5 to 10 years. But thank you for your time.
And get a good beer and a good concert.